Cognizant announced earnings on Tuesday, reporting that net income rose 22% and revenues rose over 40%. To tell us more on the company's growth strategy and how they plan on sustaining this, we talked to the company's CFO, Coburn, in New York.
When we look at our corporate strategy, it's very simple. Maximize revenue growth while maintaining stable margins, which are lower than many of our competitors. So we target a 19 to 20% operating margin. Take all the dollars above that, reinvest into long-term revenue growth, which really means reinvest into what clients are looking for, which is the strong front-end capabilities, relationship management, industry expertise, consulting capabilities, program management capabilities. We've been making those investments for a number of years. Now, what has started to happen? For the last 2 years, clients slowed down on the discretionary development work because times are tough. Now what we're seeing is clients starting to spend on discretionary development again. And as they do that, they're looking for a partner who has a combination of strong delivery and a strong front end. And we're somewhat uniquely positioned for that. In this most recent quarter, on a sequential basis, our overall revenue grew about 15%, but our discretionary development revenue grew 22% sequentially. And we think that's one of the reasons we're well positioned for the future and why we took our revenue growth expectations for 2010, calendar 2010, up to at least 36%, which is obviously far above the rest of the industry. It's because we're getting a disproportionate share of this development work. Now, as you win this work, these aren't projects that last 6 weeks or 8 weeks. These are projects that last for a period of time. So the surge that we saw in the second quarter provides a new baseline that we grow off of. Mm-hmm. Now, I would not expect us to be able to grow sequentially at the rate we did in the second quarter. I expect sequential growth will slow because in the second quarter, we benefited from pent-up demand to start new projects. Now, those projects have started. We'll get some additional ones to start, but not the same number. But because it's a recurring revenue model, once you have those projects, that's sort of built into your new baseline of revenue. So we certainly don't have any guidance for 2011. We haven't even started discussions with clients. But the good news is, given the baseline of revenue that we have, we think we're well positioned to continue to have industry-leading revenue growth. When we look at clients, I break into two parts: strategic clients and our overall customer base. Our number of strategic clients increased by 6 this quarter to 155. These clients drive the vast majority of our growth. These are clients that we're seeing more and more are interested in partnering with us for a broader range of services. So we're feeling very good about that. A strategic client for us is a client who will generate anywhere from $5 million to well in excess of $50 million a year in annual recurring revenue. It doesn't mean that they sign up for that day one, but where they have the desire and the capability to grow into a multi-million-dollar account on an annual basis. By industry, historically, there are a lot in financial services and healthcare. We're now starting to win a lot of clients in information media, in retail and manufacturing, in telecom. So the base of diversity of our client base is expanding quite significantly. From a geographic standpoint, we're still about 78% revenue from North America, but we continue to win new clients both in Europe and increasingly in Asia. So over time, I would expect Europe and Asia to become a higher percentage of our revenue. In North America, things have bounced back quite nicely. Obviously, the economy is more stable here than in Europe. We've seen a very strong rebound in discretionary development spending. But when I look at Europe, we had a lot of strength, some of it related to M&A work. But beyond that, it's still a very fragile economy. And we expect growth, but I would expect North America to lead Europe in growth for the next couple of quarters. Asia is doing very well on a percentage basis, growing off of a small base. In particular, India, Singapore, and Japan, we're seeing very nice growth at this point. Asia altogether is about 3% of revenue, so it's still relatively small, but growing on a percentage basis, growing astronomically. So if I think about Asia, where I would include Australia, so India, on East, Today it's about 3%. Clearly that'll grow significantly faster than the company overall. I don't have a specific target, but it'll certainly be a lot more than 3% over the coming years. South America is still early. We're using South America as a development location, so we have development centers down there. The direct sales in South America are still fairly modest, so I think that'll be a little bit slower than Asia. We have a fundamentally different strategy than many of our India-based competitors. But both of us have very legitimate, valid, good strategies, but different. Our strategy is to maximize revenue growth at the cost of margins. So we do not have the highest margin in the industry. We don't want the highest margin in the industry. We want stable margins at 19 to 20% excluding option and equity expensing. We're there. We have no desire to increase margins. What we have a desire to do is to be the industry leader in terms of revenue growth and to take market share. Many of our competitors have much higher margins, and you can't have the highest margins and the highest revenue growth. It's impossible. You got to do one or the other. So I think we are somewhat uniquely positioned on the strategy of let's maximize revenue growth. We measure success on are we growing materially faster than the rest of the industry, and I think the success that we demonstrated this quarter is a direct result of the investments we were able to make due to the fact that we run at a lower operating margin. We hired very heavily in Q4 and Q1 of this year, 17,000 in those 2 quarters, another 3,000 net in the second quarter, so 20,000 people over the last 9 months net. We will, from the 3,000 we hired in the second quarter, we will clearly accelerate hiring in the second half of the year. Because revenue came in so strong in the second quarter, utilization went a little bit higher than we'd like, and we'd like to bring it back down. So we'll certainly be out there hiring both laterals and also hiring off of college campuses. Over time, clearly all of us have to figure out how do you break the linearity between revenue and headcount. There is no silver bullet. It just doesn't exist. So it'll be a whole combination of things, including going to fixed-based pricing, outcomes-based pricing, share gaining, as well as moving more towards platform-based services. So that's an important word, though. We're not in the business of selling software. We don't intend to be in the business of selling software. But we will sell services that we provide on our technology platform. And we're starting to do that in some finance and accounting areas, in some data analytics areas. I think you'll see more of that. So sort of think about that as part of our cloud strategy. We refer to that as business process as a service, and clearly we'll be a player in that. What percentage of revenue that'll be over time, we'll see how well it goes. If I think about a segment like retail and manufacturing, where we've seen explosive growth as that industry started to embrace global delivery, and as we've built out the domain expertise to be able to offer business solutions rather than just technology, we've seen very healthy expansion into new industries such as retail, manufacturing, information and media, telecom. We're starting to do more in engineering services. So the shift towards the newer industries is in part masked by our existing industries are doing incredibly well. And use this quarter as the example. Financial services, which we've been in for a long time, grew 18%. That doesn't mean the other industries did poorly. The other industries all grew well above the average of our peers. It's just didn't grow quite as well as financial services. But over time, I would expect the newer industries to grow faster than company average for us and to increase as a percentage of revenue. We continue to be an active player in the acquisition space, but we are very focused and very targeted. What are we looking for? We're looking for smaller tuck-under acquisitions that meet one of 3 objectives: to strengthen and expand our geographic footprint, to strengthen and expand our industry knowledge and capability, and to strengthen and expand our service line and technology. So geography, industry, and technology. Just this quarter, in the second quarter, we did 2 acquisitions. One, to strengthen our presence in France. The other was to strengthen our capabilities in large program management. And let's talk about that one for a minute. We closed the acquisition of PIPC 10 weeks ago. They do large program management. In that 10 weeks, we have already won 6 new engagements where we're doing both the program management and the execution. Without that acquisition, I'm not sure we would have won those. I think you're right that until the second quarter, IT spend for the last couple of years was very focused on being more efficient and more effective for cost savings and streamlining processes. We saw a dramatic shift starting in March and April, where all of a sudden clients were saying, yes, we have to keep spending on that, but we have to start investing for the future. And we saw clients start to invest in innovation and virtualization. And that's one of the reasons we did so well in the second quarter. As clients were spending discretionary dollars both on cost savings but also on innovation, because of the investment we made in our consulting capability and our domain expertise, we were able to meet the needs to help them to innovate. So I think there's been a significant shift in customer spending where all of a sudden customers are clearly spending again, at least spending with us, on innovation and virtualization.
Okay.
I think overall discretionary spending clearly is not back to pre-recession levels. However, for us, discretionary spending with Cognizant is doing extraordinarily well. Our discretionary spending grew 22% sequentially in the second quarter, massive growth. And we think what's happening is clients are starting to spend on discretionary development activities, and we are getting a very disproportionate share of that spend because clients have become comfortable with our model. They like the investment that we're making in innovation, in relationship management, and domain expertise. So as they're deciding to spend discretionary dollars, they're spending them with Cognizant. Clearly, we have to be very sensitive to making sure we attract and retain the world's best talent. Attrition for the entire industry increased in the second quarter. We all count it a little bit differently, but on an apples-to-apples basis, ours was equal to or slightly below some of our competitors. We were 20.7% for the quarter, but on a trailing 12-month basis, which is how most people report it, we were 15.6%, and that includes all people who leave, so apples to apples. We were okay, but it was certainly up from where we want. Now, one of the things we're very fortunate about, because we're growing so much faster, that growth creates opportunities for our employees. As you grow faster, you can promote more people. And I think one of the things our employees are seeing, that they can have a faster career path at Cognizant because of our growth. So I think we have a little bit of an unfair advantage in the war for talent because of our top line growth. And clearly, our philosophy is to share our success with our employees. I mentioned on our earnings call today that we expect to pay very substantial variable compensation bonuses for 2010 because our employees have done the work that has resulted us to have industry-leading growth. And we just finished a promotion round, a record round of number of promotions, and from what we can tell, the highest percentage of people promoted in the industry. So we're very focused on making sure we have great career paths for our employees.